This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Daniel Crosby. This is his second appearance on the show, and he brings something that I like a lot: the psychological perspective on markets, on investments. He really does the deep dive. He gets right into it. His newest work, The Behavioral Investor, examines the sociological, neurological, and psychological factors that influence our day-to-day investment decisions. And he sets forth those heuristics, those practical decision-making ideas that you can use to navigate it all. Daniel believes to have success in the markets, it's a holistic approach. It's all of these factors. There's no one magic bullet. I mean, if you're out there right now looking for the magic bullet, the silver bullet, the death cross, or whatever inane nonsense that you think will turn you into a whiz-bang investor overnight for no work, forget it. That's not where it's at. It's at exactly in the headspace where my guest goes today. Without further delay, without further me going off on a tangent, let's get into my conversation with Daniel Crosby. So in preparation of this podcast, I'm announcing this publicly. I actually went and got a foot massage, and now I'm feeling pretty good, and I'm thinking this should be part of my routine prior to any interview in the future, a foot massage. So you've started something new. Unbeknownst to you, you started this.
You've got me beat. I mean, it's 7 a.m. here, so I haven't done much.
So listen, here's where I want to start, though, a real start. I'm holding in my hands your newest book. Now, I'm going to take you, kind of weave you through a lot of interesting topics that you touch on in the book. But the first thing that I want to really ask about, I'm assuming as I hold this book in my hand, this very nice looking hardcover book, and I'm looking at this front cover, and I'm assuming this is a form of a Rorschach test of some sort, ink blots. I only see a bull. Is there anything else on this cover except a bull?
It is only designed to be a bull, but if you saw your mom or something, we could talk about that. But no, it is designed to look like a bull. You're right.
I was thinking, okay, there's going to be a trick here. There's going to be something that I'm completely missing. And now I'm talking to this guy who's all involved in the mind. He says, oh, no, Mike, you didn't see that.
No. You're wise to be skeptical of psychologists, though. This is a good life lesson that you should never trust a psychologist. So your mistrust was well placed.
Well, I don't know. I think if I've seen a lot of work in the psych space in the last 10, 15 years where I've had a tremendous amount of aha moments. So I tend to think that most of you folks in this space, when you're very transparent and very open and put all your views and research out there, I feel pretty good about taking that information in. And I think you do a good job of that.
Well, thank you. I'll take it.
One of the things that I really like as we kind of start to weave into this, I like the notion, and I said this to someone the other day on the podcast. I said, gosh, I wish I had written this myself because I would just steal it and just put it in my book, but I can't because you wrote it and, Google's going to know who wrote this forever. And so what I like, though, the real basic building block that you state, people are a fundamental unit of capital markets. The people are the fundamental unit of capital markets. That's a really nice way to look at things, given, and look, you're a younger guy, but you still have to go back and look at everything that's come before you. So you're well-versed and well-rehearsed and you know what's come before you. But that's a very different perspective to really put out there, isn't it?
Yeah, it is. And the example that I draw in the book was early work that was done in physics. And we had all these a long, long time ago. Folks had all of these sort of fancy ideas about what the fundamental units of matter would look like. And they would say, it's sort of a galaxy in microcosm, and it's, just sort of tiny galaxies all the way down. And the galaxy is made up of tiny atomic galaxies. I talk about how alchemists actually, for all of their work, a lot of the work they did was, of course, trying to turn basic stuff into precious metals, but they also did a lot to advance our understanding of the fundamental units of matter. And it was only once we grasped what the fundamental units of matter looked and felt and looked like that we could really begin to do important work in physics. And it's my assertion that until we own that humans are the fundamental building blocks of capital markets and work really hard to understand humans, we're just not going to get very far. And so, yeah, I think that is the place that we absolutely have to start.
For example, we can all think of a market chart. And you and I both know people will get their particular app, their particular piece of software, they'll print out charts. They want to look at charts. They put candlesticks on everything. They have all this kind of stuff. But what are those charts representative of? Those charts are representative of a price. And what's a price representative of?
Yeah, price is just the human attitudes in aggregate. It's just the consensus on that day.
Yeah, I mean, that's all it is. And I think it's kind of a fun way to have. Once you have that kind of philosophical construct, it's really just people determining whatever it is they want to believe is the price that particular day, but it's just human behavior embedded in the price.
Yeah, absolutely. Well, and I remember being a young college student, my dad's a financial advisor, and him saying, "Oh, would you ever want to go into the field?" And me saying, I don't like math, I like people. I mean, that's just, I look back at what a sort of silly misunderstanding that was and how little I knew about how markets worked. It's not math, it's people all the way down.
But on the flip side, you're very comfortable using math as a tool now to represent those people.
That's the thing that I love about being a psychologist who works in markets. If you're clinical psychologist, say, you're a shrink practicing out in the suburbs somewhere, you don't get a lot of real-time information about the attitudes, the values, the fear and greed of the people you're working with. If you are a psychologist who's fluent, who's conversant in math and knows a bit about capital markets, you've got minute by minute, tick by tick information on how the people of the world are feeling. And it's a really cool canvas against which to study human behavior.
But on the flip side, as you say that, one has to appreciate that that's what you're actually doing, because again, a lot of people could just say, oh, it's just charts, it's just data, but it's the representation of how people are feeling at that moment in time.
Absolutely.
So one of the things that I like at what you've done in this new work is just you've taken kind of, not necessarily a new spin, but you've given kind of a fresh perspective on issues that we've all known about for a long time. I like big, bold, basic principles, precepts, and something like saying, okay, we as humans, we're kind of stuck in this notion that when we reason, it's in social terms, and we kind of get out of the objective terms. Now we ignore the objective terms. We just stay in that kind of social space. That's not necessarily a good thing or it's a bad thing, but we as humans have to know that we do that.
Yeah, well, one of the most recurrent themes of the book is that things that are good for us as a species, things that have led to evolutionary success, have led us to live long lives and live happy lives and pass on our genes, have actually made us very poor investors. And this tendency to reason in social terms is perhaps foremost among them. I say in the book, if you think about what differentiates humankind from the rest of the animal kingdom, it's not communication, because dolphins can do that. It's not using tools, because crows can do that. The thing that really makes us different is that we're able to believe in these functional fictions. And my ideas here were vastly informed by the work of Yuval Harari, who wrote *Sapiens*. He basically talks about how the thing that sets us apart from the rest of the animals is that we can believe in things that aren't true in any objective sense, but that allow for us to build great civilizations. So an economy is something that's not true. Fiat currency is something that's not true in any sort of objective sense. But the fact that we all agree upon it allows us to build great civilization. The borders of the state of Georgia or the Constitution of the U.S., none of these things exist objectively in reality. But since we create them, we dream them up, and then we all sort of stack hands and agree that they're true. They allow for us to build great big civilizations and interact with people who we don't know that well. If you look at a monkey, they can only know and do business with at about 80 to 100 other monkeys, because that's all the monkeys that they can know and trust and vet. Well, we can do business with people we've never met. I could drive to Iowa right now and buy a Coca-Cola from someone I've never met, and that exchange would go very nicely because we're all playing by the same rules. That's good news for building civilization, but it also means that we reason in social terms. And I cite some research in the book that shows that if other people disagree with you about something, it can actually physically alter your perception of the world. Because we reason in social terms, we don't see the world in objective black and white truths. The opinions of other people can actually physically alter what we see with our eyes and what we think with our minds. And that doesn't make you a great investor, even though it makes you perhaps the member of a great civilization.
That little thing called evolution that kind of Darwin put us down the path, it's been great for the survival of us. It keeps us in the game, but it doesn't necessarily keep us in the market game.
That's exactly right. And, another easy example there is loss aversion. If, scientists look at why Homo sapiens persisted while Neanderthals and Denisovans and a group called the Hobbits who lived in Indonesia and all these other different groups didn't make it, one of the things that they point to is loss aversion. So we were, as a species, more fearful, more cowardly than the next guys. But because we were more loss averse, we took more calculated risks. We moved to new places if the food supply started to run short. And so our loss aversion, our tendency to be loss averse, led us to spread out. It led us to live on and pass on our genes, where our other sort of humanoid counterparts were out making dumb decisions that were brave but perhaps stupid. And so, we're here today because your great-great-great-great-grandfather was kind of a coward. And that was a good thing for the preservation of his genes, but it was a bad thing for us now trying to navigate capital markets in the 21st century.
So here you are, you're kind of outlining this anthropological history, a history of us human beings, evolution. But the key word is history. And that is something that I think when it comes to markets, when it comes to past experiences, even if they came before us, we're not very good at this market history stuff. Let me give an example and I'll let you comment. I've had multiple people write me in the last week, and I assume because of the volatility of the last 30, 40 days. But they've written me and they've said, look what's happening in this market right now. And what does that mean? I shake my head because here I am, a guy who's written a lot of stuff about longer term perspectives, being a student of history, saying, hey, when you look at a particular trading manager, you might want to examine a track record that goes back decades. And then all of a sudden, I'm assuming probably fairly bright people, but that lizard brain of theirs can't help but say, oh my gosh, I saw one particular movement in the last 30 days in one particular market, and therefore I infer this. And it strikes me like, my gosh, how are you missing this, the market history part? Where are you, the student of history?
So I think there's at least two psychological phenomena at play here. And one of them that's so damaging for investors is the tendency for us humans to project the recent past into the future indefinitely. A couple of months ago, did a study that asked investors what they were expecting from the U.S. market over the next 10 years. And the answers were somewhere in about 13.5% annualized. And so it's like people look at the last 10 years when we've gotten whatever it is, 15, 16% annualized in the U.S. And they go, oh, that's what reality is. I've gotten 15% a year for the last couple of years. So that will continue to be the reality into the future. Whereas in markets, we know that at least in the medium term, the future tends to look exactly opposite of the past. The truest words in investing are, "This too shall pass." And so if we've had a good 10 years, you can expect a probably not so great next 10 years. That's a truth of markets. And the other thing I think that people do is there's a huge difference between an intellectual and a visceral understanding of something. So even if someone has an intellectual understanding of market history and they've read the right books, they're familiar with the studies, that's very, very different than sort of a gut level, visceral, lived understanding of these things. Because, I give the example of our own mortality. Like, we all know we're going to die. You know you're going to die, but it's nothing you think about very much. It's nothing that impacts your behavior sort of moment to moment until maybe you have a close call in a car accident or something. And in that moment, you go, oh my gosh, like, I'm going to die one day. One day I'm not going to be here. And so those two things are at work. People are projecting the last 40 days of market volatility into the future indefinitely. And people, even if they have read the right books about market history, it doesn't live with them on any kind of visceral level.
But if they don't have an awareness, if they don't have a plan, and they let those particular, let's say the last 40 days, if they let that dominate their thinking, if that just becomes this kind of emotional thing to come inside the last 40 days and they kind of lose track of the bigger picture, that could be tough to get out of, can't it?
It can be tough to get out of. And it's why I'm such an advocate for rules-based trading and rules-based investing. Because basically, I mean, if you had to sum up the behavioral investor book in like a phrase, it would be something like, your gut's wrong 100% of the time. The thing that feels right for you to do in the moment is nearly always the wrong thing to do. And so that's why you have to take those lessons of history. You have to take those truths and those pillars that you understand about good trading and investing behavior, and you have to automate them to the extent possible. You have to set rules and lock those things in place, because you're nearly always going to want to do the wrong thing at the wrong time if left to your own discretion.
Now, of course, you take your behavioral work to many different trading strategies. For those people in my world that really enjoy the trend following approach, what you just said is kind of the spot on psychological underpinnings of, if you're going to be a trend following trader, it's about the rules. It's not about seat of your pants. It's not about discretion, sitting there each day doing some tick by tick stuff. I mean, it's just not that.
No, it's not. There's research that I cited in my last book. I looked at over 200 studies on comparing discretionary decision-making to simple rules-based, algorithmic, rules-based, systematic decision-making, and found that 94% of the time, the rules beat discretion. And I mean, you have a better life. The outcome is better, but you also have less brain damage from trying to figure out these things on a moment by moment basis. You have less heartburn, less brain damage. So make more money and live a better life by being a rules-based trader for sure.
Let's stay there for a moment on brain damage and heartburn, because I think maybe people can probably read your mind and think, hey, I know what Daniel's talking about when it comes to information or whatnot that takes place in society that might give me brain damage or heartburn when it comes to the markets. What are some of the biggest violators from your perspective? I mean, how would you outline to the audience listening when it's saying, okay, you know what? If you really go down the path of listening to XYZ for 10 years, that can potentially, maybe not exactly brain damage, but maybe you are being very literal there. But what are some of the factors that you see that people really need to just cold turkey it and stop?
Well, I outline 4 primary behavioral biases in the book. What I did is I took this universe of investor misbehavior, which is approaching 200 now, sort of 200 different biases and ways you can screw up your trading and investing. And I looked at those and I looked at the psychological phenomena that underpin them. And I said, look, there's really not 200. There's more like a handful. And there's some very consistent themes that underlie each of these 4. And so the 4 that I came up with were ego, which is overconfidence in all of its many forms, emotion, which is just what it sounds like, attention, which is our tendency to confuse salience or sort of scariness with probability, And the final one was conservatism, which is this tendency to prefer what we know, to prefer the status quo, and to prefer inaction. So there's lots of ways within each of these four that people get sideways. But I mean, if you think about what gives traders brain damage, I mean, just pick one. Ego is sort of the bias that emboldens all other biases, because this belief that we're better, that we're different, that we're luckier, all of which are facets of overconfidence, this all sort of emboldens bad investing behavior. And I think the fundamental realization that someone can have about themselves, an investor most of all, is that they're flawed and that they're mediocre and that they are prone to all the same stupidity as the next person. And it's only when you have that realization, every other thing you will learn about your life is an adjunct to that first realization that you're not that great. So it takes that realization to have any subsequent realization about what you should be doing differently.
It really is a grounding type thing that if you can allow yourself a lot of freedom, a lot of power, if you can say to yourself, my gosh, I'm just average like everyone else. But then once you admit that you're average and you say, okay, I've got all the same biases and, problems that every human has. But then once you can acknowledge that, there's a tremendous amount of power, because then once you can acknowledge it, then you can get right back to the rules mindset and say, how can I create some heuristics? How can I create some workarounds, some hacks to keep myself going on the straight and narrow?
Yeah, the market is full of paradoxes, and I think this one is the keystone paradox, which is only by realizing how not great you are can you become truly great. Because I believe that you can do great things. I believe that you can have an extraordinary life and generate spectacular returns. But all of those things are strangely predicated on admission of your mediocrity. So it's just one more paradox to add to the bucket of them that markets give us.
Let's stay there for a moment with your background as a psychologist. I mean, we're almost not even really dealing with an issue of markets, but for people to admit this, for people to admit that, hey, I'm just average and I'm not really Superman who's just one lucky lottery ticket away from everyone in the world knowing that I'm Superman. How do you start to get people over that hump? Do people have to want it a little bit? They have to want to get past something, because if people are unwilling to even acknowledge this, it's going to be really hard to get them to see your point of view, isn't it?
It is tough. And I think there's a couple of ways that we can do this. So I think the first thing to do is just look at the data. I cite studies in the book that basically say that the correlation between self-reported investment performance and actual investment performance is indistinguishable from zero. So most people, as a function of this overconfidence, aren't super up to speed on their trading record. And when they're not up to speed on their trading record, they just assume that it's good. And so take over a long period of time, take and compare, look at the relevant stats that show how you have done, because the research shows that among people who think that they've beaten the market, 1/3 of them have underperformed by 5% or more, and another 25% have underperformed by 15% or more. First thing to do is just look at the data. The second thing to do is something that you and I do, and I think hopefully that gives us a bit of humility, is that you have to teach. Because Richard Feynman, the famous physicist and great thinker, had this great technique for figuring out what you don't know. It's basically teach it to a kid. And so this is why I write books. I write books. I've written a book about every 2 years. And the reason that I do this candidly is not because it makes any money. It's the reason that I do it is to figure out what I believe and to hone my own thinking. So if you think you're sharp at something, I would encourage you to try and write a book about it, write a blog post about it, teach others about it. And if you can't teach others about the basics of a topic, you just don't know it that well. And then the third thing that I encourage folks to do is to just look at base rates. I had a financial advisor come to me recently who wanted, not a financial advisor yet, was getting licensed and wanted to start their own firm, start their own RIA. And they thought that they could get to $100 million in assets under management in under 6 months. And I said, hey, that seems really aggressive to me. That seems very optimistic to me. Why don't you look at the base rates? Why don't you look at how long it takes most people to get to $100 million? And the answer was closer to 8 years. So that's a sort of a third way, is to plan your life relative to averages. To say, look, if it takes most people 3 years to write a book, it's probably going to take me 3 years. Most people do this. It's probably going to be what happens to me too. And then be surprised to the upside if you outperform. So those three things: look at the data, just be dispassionate about that. Look at the data, become a teacher, look for ways to teach other people. That's going to help identify gaps in your own knowledge and learning. And then finally, to look at the averages. We would, as a culture, be so much better off if most people would just own that you have a 50-50 shot of getting divorced. If you, on your wedding day, you ask people on their wedding day, hey, do you think this is going to work out? And 100% of people will say yes. And yet, we as a culture have a 50% divorce rate. And I think if we were a little more honest about that from the outset, we'd work a little harder. We might go to premarital counseling. We might do the work we needed to do. So it's only when you own those averages and those probabilities that you can do the hard work that you need to do.
It's really tough about that divorce rate stat that you just tossed out there. My grandparents got to like 50 or 51 years of marriage. My parents have surpassed 50 years in marriage. So when you got these family touchstones that go on forever, it's really difficult to have that conversation. But you're right. I mean, I think about that all the time. I think, my gosh, when it comes to relationships and the modern age, you've got to look at the base rates. You've got to say, what is average? What is the probability? That doesn't mean you go into something, looking for the worst, but you also should not be having the rose-tinted glasses on, imagining that, it's all pie in the sky.
You make a great point there, because I want to be clear here, because if you look at the base rates alone, no one would ever start a small business. No one would ever open a restaurant, because probabilistically speaking, these are both low percentage shots. These are not great ideas. And I'm glad people start restaurants, and I'm glad people start small businesses. But just use these base rates to sort of chasten your thinking a bit, not saying, 50% of the world gets divorced, so like you're doomed to a life of being on your own. That's not the takeaway. I think the takeaway is, 50% of people get divorced. So work hard at it. Take a class on communication, go to counseling, look at your own quirks before you try and bring someone else into your life. And the same can be applied to investing. More than half of individual equities have catastrophic losses over their lifetime. The life of an average stock is nasty, brutish, and short. And so if you think you know something, if you think you want to take a large position, or you think you want to invest in something, be damn sure that you've done your homework and know the probabilities are not on your side. And so make sure you have an edge, make sure you've done your homework, and don't never take the shot. Just make sure it's an informed shot.
Yeah, it's a great point. There's a great piece out there by the late, great Stephen Jay Gould out of Harvard. And I believe he got an early cancer diagnosis. And basically the doctors did one of those typical things like, you got XYZ amount of time and then you're gone. And that happens to, 60% of people or whatever. But then he went ahead and he looked into it further to say, well, what does the data really represent? Which is, I think, is where you're trying to go, which is like, if 50% of marriages end in divorce, well, is there something we can look further at those particular marriages? And of course, this kind of thinking could apply to investments as well, is to dig in a little bit further and find out, perhaps did those winners do something a lot different than the people that bailed or the people that did not succeed? So it becomes a challenge. There's never kind of some surefire way. You really got to do the work.
You really do. You really do. And, another thing that I talk about in the book is one of the surest ways to have a disappointing life and a disappointing trading life is to believe that you can perfectly manage risk. So you really do have to walk this tightrope and say, look, there's some risk inherent in any good thing you would ever do. And if you try and live a life wrapped in bubble wrap, you're going to be broke and sad. So take risks, but take appropriate risks. And I think that managing overconfidence is one of the primary means by which you can help walk that line.
So as you bring up the idea of living in bubble wrap, we were kind of talking about big populations under the bell curve in the middle. I think most Americans that have their typical retirement account are slammed into a passive index fund. Kids are going to do the standard issue 4-year degree, get out and try and get the standard issue job if it still exists. There is a lot of bubble wrap thinking. I mean, it really does require you to kind of get outside the box to get into the mindset of the behavioral investor.
It does. And one of the things that's true of life and markets is many people are content to work their mediocre jobs with their mediocre degrees and come home and have a hungry man dinner and fall asleep watching their favorite shows, right? I mean, that's, I think for most people under the bell curve, that's always going to be the case. But you got to remember too, that therein lies the potential for success, the potential for arbitrage for the behavioral investor, for the person who's willing to stay up a few hours later, to do a little extra work, to do a little extra homework, to endure a little extra discomfort, because I think if there's no pain, there's no premium. So I think a lot of times the pain is psychic. So I think for people who are willing to put in the work and endure that pain, I think therein lies the opportunity for a rich life and a richly rewarding trading life as well.
Hey, by the way, there is no particular, and I've seen you write about this, there is no particular personality type that if one wants to go down this path of thinking in rules and kind of pushing discretion out of the toolbox, there's no personality type, is there? I mean, it can be anybody.
There's not. So I was interested in this. People have asked me why write another book relatively hot on the heels of my last book, The Laws of Wealth. And one of the reasons why I wrote this book is I go to so many conferences. I'm a frequent conference speaker, and I was just hearing so much bad information set forth by trading gurus and behavioral coach types that are loosely regulated and experts in their own mind. And
give me some examples there. I want to hear some of the latest trading guru nonsense that's being pushed.
There were a couple of things. And one of the big ones was this idea of personality. That's like, I've got a personality test and we're going to tell you if you've got the right chops to be a trader and you're a good investor, and here's the personality traits that you need. And I dug into the research, and it's nonsense. I mean, there's people of all types, people of all stripes and walks of life can be great investors. It's more about following rules than coming out with some specific personality type, which is good news because science is telling us now that about 50% of your personality is set genetically, and about 10% of the decisions you make are down to situational variables, and about 40% up to the choices you make. Effectively, what these folks are saying is you're born with it or not, and I would take strong exception to that. What I found in researching the behavioral investor is that personality types of all kinds are potentially well positioned to be good investors. It's really more about following a set of rules than being a specific type of person. The other thing that I found very consistently was sort of misinformation around emotion. There's a couple of chapters in my book about emotion, and it's very nuanced, but these folks were kind of saying, look, tap into emotion as sort of this sixth sense of where you should be doing. Long story short, the data does not support the fact that strong emotion is a good tell or is a good trading signal. In fact, it's usually very bad.
As we're talking about personality and the idea that anyone can go down the right path towards being a good investor, I'm thinking to myself, the conversation comes up, you're at a particular conference, the conversation comes up, somebody, a guru, etc., is saying, you really need this particular type of personality. Now, there's an audience out there. The audience is, let's say, 500 people. So there's a guru on the stage. He says, you 500 people out there need a certain personality. What I immediately think about is how many people in the audience think, my gosh, that's absolutely bullshit, versus how many people think, oh my gosh, he's going to tell me if I'm in the club or not.
Yeah. So one truth about life, I think, is that people want easy answers to hard problems. And so saying, I've got a personality test in a course that'll tell you if you're on the right path and put you on the right path is an easy answer to a complex thing. And so I imagine there's many, many people who want to pick up what this guru is putting down. But there are certainly people who also are informed consumers and understand that in a lot of cases, this is a sales thing. People have a hammer, so they see nails everywhere, this sort of thing. I think you're always, again, going back to our person that's eating their TV dinner and watching their shows. I mean, there's always going to be people who think, oh, good, here's a silver bullet, and this guy's figured out what it takes. But I think the ability of some subset of the population to think more critically, take the road less traveled, is where our potential for outperformance lies.
As you give this very nice, studious presentation, speaking with me tonight, this morning in your case, I'm looking at a particular quote that you cite in your work from Pliny the Elder. The best plan is to profit by the folly of others. That is hardcore for some people. The best plan is to profit by the folly of others. I assumed when I saw it in your book, you meant it for what it is. But of course, one can take that emotionally. They could take that in a negative connotation, or they could take it like you just said a minute ago, which is like, hey, if you want to be average, you can be average. But if you want to spend a few extra hours a night, you can find out how the game really works. And the game does really work by funneling and channeling money from people that are making bad decisions with bad plans to people that have good plans and make good decisions.
Yeah, that's right. And I don't want that to sound overly aggressive or antagonistic. It's just sort of a fact of life. There's always going to be a large percentage of the world who's trying to get rich quick or take shortcuts or not do research or not do anything. And yeah, again, those people who are willing to endure the pain to get the premium, and the people who are willing to do the work, it's not like they're tricking other people or they're being mean to other people. They can just sit back and patiently know that as they are systematic and cool, calm, and collected, they can know that other people won't be taking that path. Like, I'm bullish human irrationality from here to forever. If we follow that path, we will profit from the folly of others.
Now, look, there's a lot of things that I've said in this conversation, things that you've said, things in your book, which can cause people that are really invested in that ego, really invested in their emotion, they can react very violently to being challenged. I mean, they can be challenged by you giving a presentation, giving a podcast interview. They can be challenged by your work. But just from a big conceptual perspective, people often don't like to be challenged. If they're set in their ways, they really don't want to hear it. I mean, I had a guy who was just emailing me with me before our conversation. I was kind of trying to give him a basic explanation of what a price breakout was. And he kept coming back to me with all these candlestick charts and all this candlestick nonsense. And I just said, what are we talking about? I don't even talk about this stuff. Where did it even come from? And I literally had to kind of say, stop that. And I could feel that he didn't like being challenged. Here he is coming to me saying, how do you do what you do? And I'm trying to tell him, but he's basically trying to use all of his examples from whatever his world is. And I'm telling him to stop. And he doesn't like that.
Probably my favorite psychological bias is something called Dunning-Kruger effect. Dunning and Kruger were these researchers who their stream of research was prompted by one of the most amazing things I've ever heard of, which is someone tried to rob a bank covered in lemon juice. So this bank robber covered his face in lemon juice and goes in to rob a bank, and of course gets caught very quickly. And the guy is sort of flabbergasted when he gets caught, and he goes, oh my gosh, how could you see me? I thought I was invisible. And they go, what? And he said, well, yeah, when I was a kid, I would do invisible ink with lemon juice. You know, I'd write on paper with lemon juice, and it was invisible ink. So I thought that the lemon juice would make me invisible too, and I'd be able to rob this bank. And so Dunning and Kruger are like, whoa, what is going on here? And they do research on how effectively dumb people are too dumb to know how dumb they are. And the same thing can be said of arrogance or overconfidence. Like if you've read my book or you've listened to this podcast and you're thinking, you know, what an idiot. This guy doesn't know what he's talking about. This isn't me. This is so not me. I'm not susceptible to any of this. The fact that you think you're not susceptible to any of this overconfident stuff, any of this bad behavior, is the surest indicator we have that you are susceptible to it. And again, paradoxically, if you've been listening to this and going, wow, you know, I really have some improvement to make, I could do a lot better, you're actually probably okay. So it's a weird thing that the most overconfident people in the world aren't well positioned to realize their own overconfidence except if they realize those feelings of defensiveness. So that's just a good gut check, I think, is to say, look, if you feel enraged by what someone's trying to teach you when you're working with this guy, if you feel defensive or angry or whatever, that might be a good prompt to say, hey, maybe check your ego at the door.
Yeah, it's very difficult for people, really. I mean, it's extremely difficult to watch people in the throes of it. And you want to be very frank with them and be very open. But sometimes you just got to let the chips fall where they may. I mean, tell people, here's the perspective, here's how I can help you, here's what's really going on. But, some people, they might not make it there. Flying out of that for a moment, because I could take you to so many different pieces in your work. There's a line that I caught here, and I don't think I've ever written anything like this myself. I love it. It's very simple. I think, though, the only problem is when you write a bunch of stuff, and I'm sure you face this too, you sometimes forget everything you write. You can't remember. You almost have to search it. But I love this line here. Data without theory and theory without data produce spurious results. I mean, data without theory, these are the guys that sit on a backtesting engine and find something that has no real grounding in real life and think they've got something. And then there's the folks that have this fanciful theory about, freaking the golden mean and the pyramid is got this particular triangle and therefore it means this. And but that's a great line. Data without theory and theory without data produce spurious results. Fantastic.
I appreciate it. So yeah, you're exactly right. So you need, I think, three things. I think you need theory, I think you need data, and I think you need psychology. The reason you need theory is just the reason that you said. The Fed produces 45,000 different pieces of economic data that they report on. So if you put all of these data points in a blender and regress them against the S&P 500 over the last 100 years, you're going to find some correlations, and a lot of them are going to be meaningless. There's all the funny ones. There's, like a 95% correlation between moves in the S&P and Bangladeshi butter production. And, there's the Super Bowl indicator that's actually still pretty good. I can't remember if the AFC wins then something. But anyway, yeah.
But to use that information is gambling.
Oh, yeah, absolutely. So this is data without theory, and you can just get silly results, spurious results that have no basis in fact. Now, the flip side is also problematic. You've got some great macro narrative. You've got some theory about the golden mean or whatever sort of fanciful idea you have, but that needs to be backed up by the data. If there's really something there, your theory needs to be sound, and then you've also got to have the data to prove it out. But the third piece, that I want to talk about is I think it needs to be rooted in behavior, because market anomalies that we discover that have no pain, that have no behavior associated with them, I think they quickly get arbitraged away. Calendar effects and all these little quirks in markets that we can discover and go, oh, gee whiz, that's easy. And that gets quickly arbitraged away. I think the only enduring edge is this confluence of these three things. It needs to be grounded in a sensible theory. There needs to be data to back it up. And there also needs to be some sort of behavioral reason why it exists, because behaviors persist. Even bad behaviors, even irrational behaviors persist. Even if people know about it, can be hard to arbitrage it away because of bad behavior. So I would bet money, if there were a way to do it, I would bet money on American obesity for the next 50 years. Because even as...
Getting worse, you mean?
Getting worse, yeah. Because even as we become more informed, even as we have more healthy food available to us, even as we become more informed about nutrition, it's just still hard to eat the right thing. It's still hard to exercise. I'd bet on that bad behavior going forward, even as new information comes online. And similarly, I would bet on things like value and momentum long into the future, because they have behavioral underpinnings to them.
You're laying out a case on this podcast in your books, what I would call as a contrarian perspective. I'm curious to hear your definition of contrarian, but I would say it's a contrarian perspective. Now, a contrarian perspective kind of sounds good to all of us rebels, all of us kind of entrepreneurial perspectives. Oh my gosh, I'm a contrarian. Now, the flip side here, though, is the contrarian perspective doesn't mean you are going to be without pain. It doesn't mean that it won't hurt. And I think that's another element to this too is that once somebody goes down the path that Daniel Crosby is outlining, the kind of like put aside the discretion, get your system, automate. That doesn't mean that you're going to make 5% a month every month for year after year after year.
No, it doesn't. And in fact, basically any reputable system you could dream up is going to have periods of underperformance. I mean, if you've back tested something and it never underperforms, then you've got spurious results. Once again, you've got a Madoff machine, not a real strategy. I cite research in The Behavioral Investor that compares value investing effectively, or contrarian investing, value investors in particular in this study, but it compares the emotional response to being a value investor to stuff like being picked last at kickball, to things like social isolation. So being a true contrarian, which is exceedingly rare, everyone thinks they're a contrarian, not many people truly are, but being a real contrarian hurts like hell. It's socially isolating. You're going to think you're crazy. You're going to think you made the wrong choice. If you're not experiencing those things from time to time, you're just not a true contrarian. I cite research in the book. I talk about this funny book about sort of rebels and punks through the ages, and how something like a gutter punk or a prep or something would have more of a uniform than your average businessman. People who have mohawks and leather jackets, they think they're going their own way, but they adhere to tighter social protocols than your average stockbroker in terms of what to say and what to listen to and what to wear. Contrarianism is one of those things that everyone thinks they are and not many people are. And the true way to determine if you are is how much it hurts.
I was thinking about the curious case of social media. I will not throw a name out there or any kind of reference to a particular individual, but I see quite a bit these days where people are involved in social media and they put their public face out there, and they are perhaps associated with people that have radically different views. But because of these kind of social constructs where they don't want to really upset the apple cart, they kind of just stay associated with it all. And even though it might be bad information that's coming into their noggin every day, they still do it. Then on the flip side, they might go outside of the social network and then complain with other people that have the same kind of view. I'm seeing this quite a bit where I think that social pull, which is a lot of what you write about, that social pull to fit in, that even if it's against your very basic nature that you know is wrong, this desire to fit in and be a part of the team and don't feel isolated. Boy, that's really tough to overcome.
It is tough. And yet I've found personally, this is just anecdotal experience. I quit Facebook a few years back, nearly 3 years ago now. And when I did, it was like an immediate 10% boost in productivity and happiness. You think you need these things. You think that you're using these tools to become socially connected, but all of the research points to social disconnection and very sort of fleeting, superficial connections that happen over social media. Now, I think social media can be used to be a catalyst for in real life connection that can be very, very powerful. But if all you're doing is talking with people or arguing politics with people on social media, I think the damage can be considerable and the upside is limited. Put me in the camp that thinks of Facebook as sort of the new Philip Morris in terms of its contribution to society.
I think that's a great place to end it. Facebook is the new Philip Morris. So Zuckerberg is right now will be getting ready to scan this podcast, reduce it to text, and send an army of bots out to ruin our lives. I'm
about to say, when I die after this podcast is released, go look for Mark Zuckerberg. Yeah.
Yeah, exactly. Okay, the book, The Behavioral Investor, out now and about. Find it anywhere and everywhere. Daniel, where is the best website that people can go to find out more about you?
The best place to find out more about me is Twitter at Daniel Crosby. I have my own podcast, the Standard Deviations Podcast. Or look me up on LinkedIn and connect with me there.
Cool. When did you start the podcast? How long have you been doing it?
I've been doing it for 50 episodes, so about a year now.
It's addicting. You'll never stop, right?
I love it.
It's literally, it will be impossible for you to stop. You start to get 50 plus. It's going to be like, because you get a chance to talk to interesting, wise people and have cool conversations. And again, it kind of keeps you out of Facebook, keeps you off Zuckerberg's hit list.
That's exactly right. It's a professional reason to have conversations with people I admire, not a bad gig.
Daniel, I appreciate you coming on again. Please let me know when the next book is out.
I'll see you in 2 years.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.